Late payments hurting your cash flow? Learn how to record late payment penalties correctly in accounting. Imagine sending an invoice and waiting for payment only for it to arrive late. What do? Today we will break down how late payment penalties are treated in accounting clearly and step by step. This topic is crucial for small to medium sized businesses and students learning real world finance. By the end, you will understand the principles and workflow behind accounting for penalties. Late payment penalties are fees charged when invoices are paid after the due date. They are usually calculated as a percentage of the overdue invoice. Besides encouraging timely payments, these penalties also have accounting implications that business must record properly. Recording penalties incorrectly can distort revenue figures and financial reporting. Even a small penalty misclassification can make projects appear more or less profitable than they actually are. Correct treatment ensures accurate reporting and better financial decision making. Penalties are not treated as main operating revenue. They fall under penalty or other income. Accounting follows the revenue recognition principle, meaning income is recorded when earned, not when cash is received. The first step is classifying the penalty structure. Some businesses charge a fixed late fee, others apply interest, while some calculate penalties based on how many days the invoice remains overdue. Correct classification determines how the penalty is calculated and recorded. Penalties should not be recorded when the client pays them. Instead, they are recognized when they become enforceable, usually after the due date and any agreed grace period. This prevents premature revenue recognition and keeps financial records compliant. To record a penalty in accounting, debit accounts receivable for the penalty amount and credit penalty income or other income. Separate this from normal sales revenue, keeps financial statements cleaner and improves analysis. Business should maintain a penalty register or spreadsheet to track overdue invoices and calculated penalties. Penalties should appear in the other income section of the income statement. Avoid mistakes like mixing penalties with service revenue or recognizing them before they become enforceable. Clear payment terms help reduce late payments and avoid misunderstandings. Communicate penalty policies upfront so clients know the consequences of delays. Using automated invoice reminders also helps encourage timely payments and maintain steady cash flow. If a client pays a $1,000 invoice 35 days late and the penalty is 5%, you record a $50 penalty. Debit accounts receivable $50 and credit payment penalty income $50. By following the four-step process, classify, recognize, record, and track, your accounting remains accurate and reliable. Thank you very much.